The multi-year artificial intelligence supercycle just hit its first major structural speed bump. What the market is calling a chipmaker sell-off is more than just a momentary blip. It's a critical stress test on the market's most expensive narrative. Is this a healthy reset, or are we witnessing the first cracks in the foundation of AI's lofty valuations? Today on SR Money News, we're cutting through the headlines to analyze the institutional implications of this downturn, particularly how it's poised to ripple across Asian markets and reprice the entire global tech landscape. Let's first establish the core moat of the semiconductor industry. It's not just about silicon, it's about the intellectual property, the extreme capital intensity, and the decades of R&D that create barriers to entry. Companies like NVIDIA, TSMC, and ASML are not just producing components, they are the foundational layer of the digital economy. Their value proposition is the infrastructure upon which every other tech megatrend, from cloud computing to generative AI, is built. This interconnectedness makes their performance a bellwether for the broader tech sector. The operating segments within this space are highly specialized. NVIDIA dominates AI accelerators. TSMC is the world's leading pure-play foundry. ASML provides the critical lithography equipment no other company can replicate. These aren't commodity businesses. They operate with high switching costs and network effects, reinforcing their competitive positions. But this concentration also creates systemic vulnerabilities if the demand drivers, specifically for AI, begin to show any signs of softening or irrational exuberance. While we don't have new company-specific quarterly results from the current news, the market's reaction is the earnings signal here. The chipmaker sell-off reflects investor anticipation of potential margin contraction and a slowdown in revenue growth from previously explosive levels. Why? Because the market is questioning whether massive AI investments by hyperscalers like Microsoft, Google, and Amazon will justify the lofty valuations of the underlying hardware providers. This perceived risk directly impacts future earnings visibility across the sector. This shift isn't necessarily about a collapse in demand, but a recalibration of expectations. Institutional capital has been pricing in near-perfect execution and exponential growth for months. Any sign of deceleration, or even a questioning of the pace of return on AI investments, can trigger a sharp repricing. We're seeing a liquidity shift away from pure growth and into more defensively structured assets, as the market digests whether the build it and they will come mentality for AI infrastructure truly translates to sustainable profit growth for chipmakers like Intel and AMD. Now, let's consider the management commentary we've heard recently, especially from the sector's bellwethers. Jensen Huang of NVIDIA has consistently emphasized the long-term, structural demand for accelerated computing. Pat Gelsinger at Intel is pushing a strategy to regain foundry leadership. These executives aren't just selling chips, they're selling a vision of an AI-powered future. Their capital allocation decisions are massive, committing tens of billions to R&D and capacity expansion. The current market action suggests that while the vision is compelling, the corporate guidance, particularly on the pace of monetization for all this investment, is now under intense scrutiny. The key here is execution strategy. Are these companies diversifying their AI revenue streams beyond just the hyperscalers? Are they finding new markets for their AI solutions, perhaps in enterprise or sovereign AI initiatives? Any slowdown in data center buildouts or even a slight deferral of capex by major clients would directly impact their top lines. Management's ability to navigate this period of valuation reassessment, without signaling a fundamental shift in demand, will be crucial. This isn't just about what they say, but how the market interprets their measured optimism against rising skepticism. Stepping back, the broader industry context for semiconductors is complex. We're still in the throes of an AI arms race, but also navigating geopolitical tensions and a lingering cyclicality in other segments like memory. The competitive landscape is heating up, with companies like Samsung and even sovereign nations pouring resources into their own chip capabilities. This global competition, combined with a volatile macro environment of high interest rates and inflation, creates significant headwinds. The sell-off in Asia stocks, tracking the US chip slide, is a stark reminder of this global interconnectedness and how localized shifts in sentiment can spread rapidly. The key question for institutional investors is whether the secular tailwinds from AI can offset these macro pressures. Demand for advanced chips isn't going away, but the pace and profitability of that demand are now being rigorously re-evaluated. Are we moving from a period of unconstrained spending on AI infrastructure to one where return on investment dictates the pace of CapEx? This transition will naturally lead to some volatility, but it also creates opportunities for capital rotation into companies with stronger balance sheets or more diversified revenue streams within the tech ecosystem. Let's confront the elephant in the room: systemic risks. The primary vulnerability is the massive concentration of wealth and future earnings tied to a relatively few megacap tech stocks, many of them chipmakers. If AI investments don't yield the anticipated returns, the valuation extension in these companies becomes unsustainable. Beyond that, we have cost inflation impacting materials and labor, regulatory pressure regarding market dominance, and the ever-present threat of geopolitical escalation, particularly concerning Taiwan and its role in global chip manufacturing via TSMC. Any of these could trigger further downside. Another critical risk is the possibility of oversupply in certain segments if CapEx outstrips actual demand growth, which is a historical pattern in the semiconductor industry. While AI demand remains robust for now, the future demand curve for specific types of accelerators or memory chips could soften if the adoption of generative AI applications doesn't scale as rapidly as projected. This can lead to margin pressures and inventory buildups. The market is increasingly sensitive to these nuances, leading to a more cautious stance on what was once a growth at any cost mentality. Despite the near-term volatility, the multi-year thesis for AI and semiconductors remains structurally intact. This sell-off is more likely a valuation reassessment than a fundamental breakdown. Forward earnings visibility for top-tier players like NVIDIA and ASML still looks strong, but the rate of growth might normalize. We're likely heading into a period where individual company fundamentals and execution quality will matter far more than broad sector momentum. This favors companies with diversified end markets, strong balance sheets, and proven technological leadership. Upcoming catalysts will include next quarter's earnings reports from the hyperscalers and key chipmakers, offering fresh insights into CapEx plans and AI monetization. Any unexpected policy tailwinds, perhaps from government incentives for domestic chip production, could also reignite sentiment. Institutional investors should focus on companies demonstrating relative strength, consistent margin expansion, and a clear path to generating free cash flow from their AI initiatives. This is less about calling the bottom and more about identifying durable businesses within a high-growth but highly scrutinized sector. So, where does this leave us tactically? For those with exposure to the high-flying pure-play AI chipmakers, this period warrants trim consideration on positions hitting major historical valuation extensions. It's prudent to de-risk some capital from areas that have seen extreme gains without a commensurate shift in underlying fundamentals. On the other hand, we're seeing some broader tech names, perhaps those with more diversified software or services revenue, potentially moving into breakout watch territory as capital rotates from hardware to more stable growth stories. It's a nuanced shift, but a significant one. Ultimately, the market is repricing risk, and that's a healthy process. The structural momentum for AI remains, but the path forward will be less about exuberance and more about demonstrable, sustainable earnings. Keep your eyes on those margin metrics and real-world CapEx plans. For more institutional-grade analysis and deep dives that help you navigate these complex market shifts, make sure you're subscribed to SR Money News. Hit that like button if you found this analysis valuable, and join our community by subscribing so you don't miss our next deep dive. Thank you for watching.